I'm with a fund called La Famiglia, which is an early stage fund based out in Berlin, doing seed and selected Series A tickets. We invest somewhere between about, I would say, 400K to $1 million in initial check size. About a third of the portfolio is based out in the US, 2/3 in Europe. We're a generalist seed fund. I think the USP of the fund really are the LPs in the back. So we have 50% or so kind of tech entrepreneurs invested in the fund, like Nick Zenstrom, who founded Skype and now runs Atomico, although many of us probably know him best for Kazaa and all the viruses he gave our computers. And 50% from the old economy, like the CEO of Swarovski or co-owning family members of businesses like Miele or Siemens. And so given that, we focus a lot on the B2B space because that's the network that we can lever most aggressively and is most useful to founders in that space. And so that's the general high level of the fund. And then diving into crypto more specifically, we have 2 investments in the space thus far. So one in Tagomi, who many of you may have heard of, and the other in Unlock Protocol, both of those based out in the US. And so when it comes to crypto more specifically, we focused a lot on financial infrastructure. I like to think we've been doing it before it got vogue, so for the past couple of years or so. And really, the way I like to describe it is from the outcome first, right? And the outcome I would love to see are complex financial products being built in the crypto space, right? So what is the crypto equivalent of a capital guaranteed product, for example? There really isn't one. But how do you get there? We won't get there in a year or in 2, but in 5 or 10, like how do we get there? So obviously custodians are an obvious part of that. Exchanges are an obvious part of that. Trades execution, rails, right? Derivatives volumes, both offline and online, right? Both services such as ODC desks to more classical businesses, right? Like classical exchanges. And so within that kind of framework, we've looked at the opportunities that are both decentralized and centralized. And so that's kind of what we've been looking at, what we've been excited about, and hence why it's a real privilege to speak here today. So that's the fund at a super high level. And then kind of my background, I'll keep it very brief because it's not that interesting. I've been at La Famiglia for a couple of years. Before that was at GFC, and before that was on the operating side. And before that was a PPist at the University of Oxford, where I focused on game theory and philosophy of language. So yeah, given the game theory background, I think you can see what parts of crypto in particular I fell in love with and appealed to me quite deeply. And so the first thing I'll do before moving on to the next slide is just what I want people to take away from this. And it's the power of history, right? And what I mean by that is reinventing the financial system presupposes a financial system, right? And there are lots of things that we can learn about the financial system that we can take away, whether as investors like myself or builders, like maybe some of you, I know Connor, for example, is a builder, like builders in the crowd as well, can take away. And this idea of like what we know already and the mistakes we don't have to make because history's already taught us. So firstly, what do I mean by DeFi? This list is by no means exhaustive. I'm sure to many of you it seems almost lazy or short. But decentralized exchanges, certain stable coins, basket of tokens, tokenized debt. And just to kind of re-emphasize the point I was saying earlier, don't these all seem oddly familiar? And familiar beyond the DeFi space. Before any of us heard of crypto or decentralization, or maybe even knew what a white paper was, we had seen ETFs, right? We had our equivalent of stable coins. We knew what an exchange was. And so this itself, I think, gives quite a nice framing and quite an obvious framing as to how we've already used history. And we focused on the consumer side. What do the consumer wants? What do consumer needs? But we maybe haven't thought of it more from the macroeconomy. And that's what I kind of want to tackle and focus on more. I mean, just to maybe ram the point home and then I'll dive into the examples. My whole, I guess, thesis about life broadly beyond crypto is that while history doesn't repeat, it doesn't rhyme. And I know this is like a pithy phrase that people like to chuck at the top of essays and Medium posts, but I think it's hugely informative. And as I mentioned earlier, right, we've already seen what history has taught us about consumers from traditional finance, and we've transplanted those values into the products that we're building today, right? What is compound? They didn't reinvent interest. That's not a novel idea in any way, but they just enabled it in a different way. And I think that's a great example, right? Dharma when it comes to debt. These are not huge leaps of imagination. Actually, they're not leaps of imagination at all when it comes to the end product and the end utility users are facing. It's all the other things that we have to reinvent, right? The decentralization, the economics, the incentive structures, these things are novel. But on the consumer side, we can already see things that we've transplanted and history's taught us there. And so another thing that I would love to just to emphasize that I'll be focusing a lot on the next topic is the idea of collateral. And a lot of DeFi projects in particular use collateral, I don't want to say as a crutch, because that's a bit mean and a bit demeaning, but uses collateral to enable novel use cases, right? To enable the functionality that they want to add on top of traditional finance functionality. And the thing is, we have a lot of great data when it comes to kind of capital flows that can teach us a lot about collateral. And I think that's how I'm going to structure the talk, kind of 4 examples. So initially looking at collateral, then looking at custodians, then looking at stores of value, and really focusing on what history has told us. Oh, and fourthly, focusing on staking, and then looking at what history can tell us about these 4 kind of broad topics, right? And so starting with the impact of collateral. I think many of us have seen this graph, typically in this form, but many of us have seen this graph, so a huge shout out to Mike McDonald, whose work has been sent and shared through more Telegram channels than I guess he would care to know about. And rather weirdly, this graph actually ends on the 23rd of June 2019. I'm actually not sure why that is, but that's why there's no August or September figures. And this is actually the best visualization. So hence why I've taken this opposed to maybe something that was more up to date, but just looks a lot uglier. And so what is the kind of key takeaway here, right? I mean, it's obvious, a lot of collateral is going into Maker. But the example I want to focus on is when we take away Maker and focus less on Maker and look more on Compound, right? And the growth of Compound is really obvious. And I think the value of Compound is really obvious, right? Basically interest, creating money markets. And while we can see that this success is at least partially due to excellent execution, the partnerships that they've had projects with Multis, who I believe were speaking in another room earlier today, and other distribution channels, a lot of it is taking just a utility that we know consumers want, right? And I know it feels that I'm hammering on this point a lot, but the reason I do so is just to get across the strength of my conviction here, in that using history is not something that we haven't been doing in this space already. Even though many of the builders, many of the inventors are incredibly forward-looking in the values they want to espouse into the financial system, we have been using history as a proxy for consumer wants and desires. And so if we have a project like Compound, what can history has already told us about the utility, but what can history tell us about the capital flows down the line, right? What happens when we move from 160 million or so USD, which I believe is what's collateralized right now, to 1.6 billion, 16, 160 billion. And that's why I'd like to make the rather non-secular jump to corporate bonds. And I know this seems a little bit of a harsh and kind of curt segue, but I'm quickly going to run through it, so bear with me. And the part of the graph that I'd love for everyone to focus on is from kind of 2015 onwards, right? Do I have a pointer? Oh, I do. Perfect. So from here onwards, and you'll notice that there's 3 key parts to the graph, right? Foreign purchase of US corporate bonds, the change in dollar reserves, and US purchase of foreign debt. And typically purchase of US bonds has correlated quite a lot with Federal Reserves, right, and reserves of dollars. But we can see from 2015 there seems to be a little bit of a disaggregation. And the question then becomes, why is that? Why has there been this disaggregation? And the reason is quite simple, and it's twofold. One is institutional investors, particularly European investors, after QE, who are looking for increased returns that were not available in the domestic markets. And secondly, from Asia, economies such as Taiwan, Korea, where due to fiscal tightening, capital had to flow outwards towards the US debt markets. Now this, I understand, seems, again, as I conceded up top, a rather harsh non sequitur into something totally unrelated to what I was speaking earlier. But I think the way that at least I view this is the idea of capital flows, and that the idea of capital flows at the macro level. And the reason I view it in this way is these aren't problems, these sorts of considerations aren't considerations for Compound right now, right? Compound is at 160 million odd. It's about educating consumers, it's about distribution, it's about the classic startup issues. But the reason that these sorts of graphs and I feel these sorts of historical precedents are important, because where do we want, or particularly the team, but those of us in the space who are true believers, where do we want Compound to go? Do we want it just to be a niche product for people who hold crypto, or do we really want it to change and fundamentally restructure the financial economy. And I think many of us are believers in the latter sense, right? And if you are a believer in the latter sense, we speak quite highly about disrupting gold or disrupting payments, or whatever else it may be, right? The killing off of the dollar, the killing off of fiat. I think not everyone, but many people have at least one of these very, I would say, ambitious goals. But to reach that really means that you're impacting the world on a global scale. And to go back to this graph just quickly, this graph is taken as a part of an analysis into US balance of payments, right? So the inflows and outflows of the world's strongest economy. Isn't this the type of asset class we want to build, right? And I know I focus on compound a lot, but there's obviously more to it than that, right? Across the various forms of disruption that we're seeing. But the point really is that right now we're focused on the micro, we're focused on product, we're focused on building that product, we're focused on distribution and education, all these other things that are seemingly incredible hurdles, right? And I don't in any way mean to disparage that. But in 10 years, in 15 years, in 20 years, don't we want topics of crypto to be the subject of discussion in the Financial Times? Isn't that the end goal if you're really a DeFi believer, right? And not in some sort of kind of kitsch, oh, Bitcoin went up 2x in the last 6 months, it's all wash trading way, but in a really meaningful way. And that's why I like to think about the world in these sorts of historical precedents, right? Because we don't really think or talk about interest rates or fiscal policy, but that impacted US corporate bonds. And the end goal of crypto will be that it will impact a lot of what perhaps people in this room are building, or people in this building are building, or people around the world who haven't thought about building it yet will build. And so that's like the first analogy that I would like to kind of draw when it comes to crypto and the macroeconomy. As I mentioned earlier, I kind of have 4 examples. So the next one is on custody. But yeah, I like to make it interactive, and I realize I've been monologuing for a while, which I hate even when I'm speaking. So are there kind of any questions or anything that you would disagree with, or anything that you think is just plain outright stupid? More than happy to have a riposte. Otherwise, I'll dive into the next section. Cool. Awesome. So the next part is custody, which I guess many of us know quite a lot about, right? We know the pain points custody is solving. We know it's a part of the traditional financial infrastructure that really needs to be recreated in the DeFi space, or more broadly in the crypto space. Maybe not specifically in the DeFi space, but in the crypto space, right? And removing issues when it comes to kind of counterparty risk. And since we have such great data on custody, one thing that history kind of tells us, I feel, in quite stark terms, is that custody is a game of scale, right? You can look at State Street and BNY Mellon, who dominate this graph, and then you can see the absolute drop-off to JP Morgan, and then from JP Morgan to Citigroup is particularly stark, right? And the reason custody is a game of scale is for a very simple reason. It's a slim margin business where scale is the biggest driver of low cost, right? And since that, the market structure for custody, unless there's a material change in technology, at least in the traditional world, will always be one of this oligopolistic structure. But what can we really take away from this? What does this really mean if you're building a custody solution? Whether you're Anchorage, backed by Andreessen, whether you're building something in the self-custody space. Well, the first, I would say, key takeaway is that look at the market structure. Look where most of these things are custodied and how they're custodied. They're custodied by big players. And then looking at that, does that mean that this is going to be a space where big players are going to win in crypto as well? Does that mean, a Coinbase, an Anchorage, a BitGo, a Goldman, a JP, or some other new entrant who has funding and scale is going to end up winning the space? Not necessarily. What it does mean, and what I do believe, again, history kind of gives you here, is it gives you a very concrete prior. You don't have to think from the ground up about what custody can look like, but I would argue you have a very strong and robust prior that you can work off, and then you try and disprove. So if you believe that self-custody at the consumer level is what people care about, if that's what the market will look like, then you have something you're trying to disprove, right? It's not two abstract ways the world can look like. You have, i.e., one of scale and one of fragmentation and consumer-led custody, but instead it's a world where you have historical precedent and you can sit there and when iterating on product, figuring out product, see where you believe the changes are. Is it in consumer behavior? Is it the fundamental nature of the asset class? Is it the fact that modern custody solutions have come in a time when we all have a wallet on our phone, right? In a way that when these companies were built 20, 30, 40, 50, 60 years ago, fundamentally didn't exist. And then more importantly, you don't have to be just a custodian, but there's a whole ecosystem around custody. And I think the great one and the obvious one is staking, right? And so what will custody look like directly impacts whether a third-party staking service makes any sense. Because slim margin businesses almost uniformly are driven strategically to keep acquiring additional margin, right? It's almost by definition. If you only have 2, 3, 4%, whatever your margins are, if you have very slim margins, then you can't afford to give stuff up to third parties. And what are going to be the white glove services that they're going to offer? Is it really plausible that something like Anchorage or the Coinbase custody solution or BitGo is really going to give up staking, which is a value-add service that they can monetize, to third-party players in the long run? Maybe, right? You can make a legitimate argument about centralization, a legitimate argument about fundamental risks to market caps if too much of the asset is under one corporate entity. For sure, you can make such arguments. But it's just something worth consider, that from a strategic perspective, if you're building something outside of the custodian world, but inside the ecosystem, like how are these actors really going to behave? And what do you have to prepare yourself for? So if you're a project like Staked, for example, right, like what do you have to worry about when it comes to Coinbase? I'm sure they're all, very kumbaya, we're all supportive, right? We've all seen that mentality from Coinbase and it not really turn out that way. But what do you have to worry about? How do you have to position your product? And so the next thing that I'd love to talk about is institutional store of values. And the reason I want to talk about this, because in my perspective, this is the original decentralized finance innovation, right? I know a lot of what's been spoken about in this building and in this talks earlier has predominantly been projects building on Ethereum, for example. But the reality is when it comes to decentralized finance, there's a clear OG. And what can history tell us about Bitcoin and more broadly about those protocols that are attempting to be money, right? And one thing that I think is really important to flag up is no crypto has existed in a normal interest rate world. You can clearly see over the last 30 or so years, there's been a downward trend, but the 10 years or so between 2008, well, 8 more accurately, right? Years or so between 2008 or 2016 are a clear anomaly. And so given that we know cryptos have never existed in a world of normal interest rates, how do we think that's going to impact them as the Fed rates tends up over time, as the ECB raises interest rates over time? Do we believe that interest rates are fundamentally going to be at a lower rate going forward? Maybe, for sure. It's not something that I'm dismissing offhand, but it's certainly something to consider and think about, right? And why does this matter, right? Like, why am I talking about interest rates when I said I was going to be speaking about DeFi and more specifically, a project such as Bitcoin? Well, the reason being is interest rates give you the opportunity cost of holding money, right? Because the Fed rate of funds, which is what's depicted here, is what gives you the T-bond, which for, just a quick fill-in ride, is debt issued by the US government. You can almost view it as risk-free, right? Maybe some people would kind of dispute that now, but I think it's an assumption that's worth going with. And so that's the risk-free return on cash. And it's also a market that typically tends to be hugely liquid. There have been outliers. 2007 and 2009 were about 12 to 16 month period where liquidity hit all-time lows. But generally, it's a risk-free return that's hugely liquid. And so what does this mean for, again, something like Bitcoin, right? Why is this meaningful? Well, what I would say here is that my definition of a store of value, I don't think it's one that's uniform, but one that I think is hugely important, is going to be thought of in real terms, right? And so the idealized store of value at least gives you the interest rate, right? Otherwise, your money in real terms is losing its value. And so given that, how is Bitcoin going to fare in a world where perhaps interest rates sneak back up to 4% over the next 10 years? And how, more importantly, does it compete with something like gold? And I think gold is something that maybe is less in vogue now, but I think 6 to 9 months ago, I think we were all getting spammed with various think pieces about how gold and Bitcoin compete, and more accurately, look at these various features that Bitcoin brings you, portability and divisibility that gold doesn't give you. Look at the ability for you to kind of custody on your phone. Look at Venezuela, for example, as a common empirical data point that people love to point to. But again, when you have this kind of macro perspective, what I would say is viewing gold versus Bitcoin is almost viewing it in this kind of old product paradigm. That here's this existing product that we use as a store of value, and this is the reasons gold is better. Sorry, this is the reasons Bitcoin is better, A, B, C, and D, and E. And this is why people are going to flock to it in the long run, right? But what I'm trying to say is that gold is part of a larger constellation of assets that you might hold, right? That include things like T-bonds, right? That include things like non-US debt, maybe European, maybe UK gilts, maybe down the line, Chinese debt. And the reason that this, again, I just have to kind of re-emphasize this time and time again, but the reason I view this as important, because if you view your belief in Bitcoin as a panacea, a store of value that is censorship resistant, then you would like to know its behavior at scale, right? And its behavior at scale is fundamentally going to be dictated by how these asset classes are changing. So a great example that I always try and keep at the top of my head is that right now, no one really views Chinese debt as somewhere where you can really put money in the store of value sense that they do T-bonds, right? But over 10, 15 years, as the Chinese economy evolves, as the fiscal tightness may change, right? We've seen a tightening recently in terms of control, but maybe in the next 10 years after the current leader, it might change. How does that impact something like Bitcoin? How does that impact beliefs in store of values beyond Bitcoin, right? I mean, I'm sure you know people who believe Ethereum also has many money-type properties, right? And so, given kind of this kind of framing, again, you can see why viewing, stores of value in particular in this kind of macroeconomic paradigm is meaningful, right? And so I think a thing that I would just love to add there is just kind of the context of gold, right? This is why do people invest in gold? Why is this the great bulwark against inflation? And part of it is historical precedent, for sure. Part of it is the supply side constraints, for sure. And part of it is just, it is because it is, right? And the thing that I would kind of like to flag up, right, is that, again, what we've seen with gold is atypical over its lifetime. And I think that's kind of best kind of sketched out in the previous graph, right? You can see the impact of the financial crisis. You can see the impact on ETFs, right? You can see the impact of these kind of huge global macroeconomic factors. And it's, again, for me, a strong argument why we need to consider them when we think about, something like Bitcoin or Ethereum or whatever is the vogue store of value going forward. And then I think another thing that this kind of impacts right down the line is things like liquidity and value appreciation, right? I think most people, or rather, unfortunately, do have an affinity or a sensibility for the appreciation of Bitcoin. But things like liquidity as well make a huge difference, for example, when it comes to store value. Again, we can see it in the macroeconomy. Markets with poor liquidity makes it hard to exit out when you need to, right? So fundamentally, when you need it most, these assets don't hold up, or the asset theoretically would not hold up, right? And just kind of viewing it in these terms, I think, adds an interesting reframing of Bitcoin and its place as a store of value. And so I think the fourth thing that I kind of want to focus on is staking, right? This is something that over time is going to get more and more interesting. And the reason I'm super interested by staking is, for me, you can see many parallels with interest-bearing assets. And I'm sure you've kind of noticed that as a common theme throughout the kind of examples, is the idea of kind of interest-bearing assets or taking paradigms from the macroeconomy. But this is one that I think is hugely, hugely interesting, because it's an asset class where you'll see the coupon, i.e. the interest, driven by network demand. And is network demand for a given protocol going to be counter-cyclical or cyclical, right? With some, we can make quite robust assumptions, right? Anything in distributed computing, you can think quite clearly that this is going to be, demand is going to be cyclical here. Because distributed computing theoretically should be a downstream impact from demand for applications built on top, right? Which will be impacted by the global economy. But also we need to think about major capital allocators. Right? So when it comes to something like BlackRock, what is the space going to look like when BlackRock is really, as part of their kind of core long-run returns portfolio, really distributing capital in staking tokens? What does this look like from a governance perspective? What does this look like from a returns perspective? And I think the reason that this is super interesting for staking protocols is this idea of rewards versus interest rates. And I think when it comes to equilibrium, what does equilibrium truly look like for a staking token, right? Is if you place it as a part of the broader macroeconomy, right, particularly for those projects that down the line will be able to support the volumes of institutional investors, like a Canadian pension fund, for example. Right? Like, what does that value, how does that capital flow? And how does that kind of impact what will be the returns for staking? Right? What is the relationship between broader macroeconomic demand and demand for the network, right? And then kind of moving on, like, where else do I believe history can help? Because I think it's probably quite clear from what I've been saying is that I feel that we don't use history enough. I think we're obsessed with the new and the shiny. But outside of the macroeconomy, where are other examples of where history can help? And I think a great one that's quite disaggregated from what we're speaking about, to be honest, over the past half an hour or so, is product, right? TransferWise, Revolut, Monzo, Number 26, Robinhood, at least for those people who are building consumer products, these people, in terms of design, UX, brand affinity, have really paved the way to get people to care for products that are fundamentally on their phone, that previously they had the security of a brick and mortar store, of a person that they could see, that they could talk to, a voice. For example, Number 26 doesn't even have a phone number. Everything is done via chat and maybe a little bit of email. And this idea of history, I've focused a lot on the macroeconomy because that's what I like to geek out about. But I think this idea of history is hugely impactful, right? Whether looking at product, whether looking at distribution, anything that is going to help crypto projects scale beyond just, the believers and the smaller groups of people who are maybe looking for a quick buck. To really break into the mainstream, history will teach us. To really understand what it looks like at scale, right? What are the key drivers of compound going to be? Not when it's at 160 million, but 160 billion. We can look at history and we can understand a little bit better. And so I think if I just had another thing to kind of emphasize that I hope kind of people take away from this, for me is really the power of history, right? And the impact that history will have on projects, that history will have on projects going forward, both projects and investors, to be perfectly frank, and what we can look for in the past and see where, it does rhyme. So yeah, thank you so much for listening. That's my talk on what history can tell us about DeFi. More than happy to kind of take any questions, any disagreements, anywhere where you think I'm just been an idiot. Yeah.
Should I have the mic or?
I have a mic for you.
Cool. This has been going on about that all day. So.
No worries.
Right. So with regards to history and crypto assets and so on, right? So would you say there's a comparison between the .com bubble we had, where a lot of that money was thrown at stupid ideas, but that money indirectly funded the infrastructure? Would you see a comparison between that and the crypto asset bubble we've seen recently with like Bitcoin and all others heading down.
So I would say that's a little bit less the case now than perhaps it was 12 to 15 months ago. Just seeing it from an investor perspective, back then, it was rather ridiculous, right? Like everyone wanted to get a piece of blockchain, to put it rather bluntly. But when it comes to your point, I'll take it in two parts, right? Like the historical precedent, and then your second point about whether that helps fund infrastructure. I'll take the second point first because it's easier. If there's more money, there are more projects being funded. So almost by definition, I would say there are infrastructure projects that are being funded out here because of a pretty robust capital markets environment. I don't think there's much to say that you can kind of disagree with. You might say on percentage terms, no, but in absolute terms, for sure. When it comes to the .com bubble more specifically and what we can kind of learn from there, well, like consumer rationality is something that you can kind of see all through modern economics, and that was certainly a part of it. I think where I would push back a little, I would say, is that when you had the .com bubble, and again, the level of dumb money, or more accurately, kind of retail investors who just wanted to make a return for whatever reason, was a lot higher than it is now, right? So what I would say is like a year ago, like maybe 2 years ago, end of 2017, like that whole bull run, then yes, I think that analogy was very strong. I think now, right, I think everyone is skeptical and I guess worried about institutionally backed investors who are very smart, very sophisticated, taking advantage of a lack of regulation, a lack of understanding, a lack of KYC, a lack of the proper protections that exist in the traditional equities markets. And I think these are the things that people are fearful about more when it comes to run-ups. And that's actually quite different from the dot-com boom. So I think initially, yes, but now what people are worried about, and I think kind of fairly, is about almost, you can view them as sophisticated attackers. That's a little bit maybe aggressive to view them in such terms, but people who just have a lot more knowledge about what they're doing.
It's thank you.
So thank you very much for the talk. I really like the whole macro approach, and I think that it's something we should think about more. I'll try and see how I could frame this question. I was having a conversation with a legacy asset manager about crypto, and he was telling me that a lot of what happened last year is what used to happen in asset managing in the 70s and 80s. And I think looking at history, one thing that we have to take into consideration is everything is kind of fun when there's lax regulation, when you can kind of play around with all these tools, but over time regulators are going to come in, and that's where I fear, and it goes to your point, that the bigger players like Coinbase, etc., are usually going to be the ones that kind of profit from that, because they're they're taking the kind of slower approach, and they're essentially going to capture most of the value, and eventually the bigger legacy players are going to capture value by through acquisitions. So it's just touching based on what you said before. I think it's useful to kind of look at the macro point of view. So it's not really a question; it's more a
no, but I certainly riff off that, right?
Yeah.
What I would say is, I don't know the specifics of your conversation with said asset manager, right? But I think like a great data point is market makers. For me, it's like a really great data point, because market makers is a low margin business, right? It's a low margin business in traditional equities, and then I'm sure we all know people who typically have moved out to Singapore and Hong Kong, running market-making businesses, taking crazy margins, right? Because right now they've not been competed away. And I think that's the kind of evidence, right, of these kind of what are, in the short run, high-margin kind of services, then in the long run probably won't look like that. And it wouldn't surprise me if that kind of like cyclical nature is reflected from what, like legacy asset managers have said. And on your second point about, well, I guess it's 2 points. I'll break it out into those incumbents who are best positioned to benefit from the regulatory kind of framework as it's evolving right now, and secondly, the idea of acquisitions. And so on that first point, totally aligned, right? And I think that at least it feels like from the outside looking in, I don't have any proprietary knowledge, right? At least from the outside looking in, that looks like it's been the Coinbase's strategy for a little while. I have question marks about how it will go, mostly because they were fundamentally a consumer retail outfit, and becoming a capitals market business is a harder pivot than I think people give it credit for. And just because they're the giant, 800-pound gorilla in the room at the moment, maybe it won't be the case in 5 years, or at least not in the way that we believe there'll be a gorilla. So I think that's the first thing, but totally aligned that playing it nice in kumbaya with regulators, it's always beneficial, right? There's a reason regulatory capture has been a buzzword in the finance sector. For those criticizing the finance sector for 20 years, we shouldn't expect that to change, to be perfectly honest. And then on your second point about acquisitions, it really wouldn't surprise me if this is a space where distribution wins. And what I mean by that is JP Morgan, Goldman or State Street, whatever, anyone with a large client book already has that kind of distribution in place, right? And all they need is the innovation. And they just need it de-risked to the point where they can buy it out at a nice all share plus cash valuation, and then add that as an incremental product line. And for me, the biggest fear there is particularly in custody, I think that's the way it goes, that you either have the one probably super well-known crypto incumbent in Coinbase launching something, and then you have, a series of, projects like BitGo, Anchorage, who I suspect, from the outside looking in again, nothing proprietary, will end up being acquired by a Goldman or a JP or whoever wants to get into the crypto custody space because they think it's accretive in some way.
Yeah, I was just going to talk as well to the custody point there, because I think, granted, at one level, this world now, you're able to have any amount of crypto assets in terms of physically carrying around the assets is no longer a challenge to anyone like it would have been with traditional, whether it was gold or actual physical cash or whatever else. But then when it comes to the actual custody piece, especially with respect to consumers, right now the way in which banks and whoever else they hold, they're the custodians of people's money, and that they provide certain assurances. If someone goes off and steals funds from you, they basically provide insurance. And with the crypto landscape, you've got exactly the same thing around mutability of transactions and everything else. And so then when you look at the custody, it's like, sure, there's not the same physical constraints around being able to store everything in a vault, but you've got the digital constraints, and you also need to in effect provide insurance for people against rogue actors spending. And so in that respect, I kind of see it as that nothing necessarily changes that much. And to your point there, that one of these traditional custodians acquires like one of the crypto ones, then it's actually not that different, the business, from what they've been doing for all these years, except they don't have the physical constraints around storing the underlying assets.
No, I think that's something that I would align on. I think for me, at least talking about custody more specifically, the only way that I would see custody kind of not evolve in the way that it historically has evolved is if there's a bigger drive for consumer self-custody. Like if there's some tailwind in whatever way that really drives that as a consumer behavior, then I would be less worried, right? If that does happen, I'm skeptical it happens in the West. Maybe other geographies, like everyone talks about kind of Venezuela or anywhere where forcible asset acquisition can happen, would be, I would imagine, better markets for it. But in North America, in Western Europe, in parts of Asia, is that sort of behavior, is it likely? Probably not, right? And if not, what's going to be the underlying driver in different consumer behaviors? I would argue nothing. And so would then be very aligned with you as well, that if it ends up being a similar market structure to that we've seen historically, it's really non-obvious to me why it would be new entrants, right? And why new entrants, maybe, once the technology is at a level of sophistication, a level of robustness, that, to put it bluntly, like once it's JP Morgan ready, right? Like once they're ready to ship it out to their customers, then they'll acquire it, right? It's not going to happen before. They don't mind paying an extra 300 million premium if they have to wait another year. But once that happens, I imagine there's going to be a spate of acquisitions in the space. Again, that's just kind of from the outside looking in, but that's been my belief on the space for a little while.
Just on that point, like, do you think that's less of a technical thing and more of a let's wait and see till someone else does it type of? So like the banks, they won't touch it until someone else touches it?
I think it'll probably be a combination of the both, right? So a level of robustness and customer service that they feel is appropriate for their clientele and what's associated with their brand. But yes, I think with most of these spaces, right, there's always a little bit of a follower mentality, right? I'm sure when there was that press release, I believe it was like July, maybe 2018, that Goldman was opening like a crypto trading desk. I'm sure a lot of banks started looking at opening a crypto trading desk. And I think the moment they were like, yeah, this is not for us, I think a lot of banks suddenly were like, yeah, this is not for us. So there's definitely a follower mentality as well. But I think a lot of it, at least for those brands and those institutions that are confident enough to kind of make their own decisions, to put it bluntly, will mostly be about technical implementation, quality of service, and these sorts of drivers. And then for others, it will very much be like a follower sort of situation. Any other questions? Cool. Yeah, thank you so much for your time. I really appreciate it. But yeah, if you have any questions, I'm literally 3 meters away. Thanks.